Friday afternoon at exactly 2 o'clock, the financial world changed forever in a single heartbeat. A single push notification on a social media app destroyed billions of dollars in paper wealth instantly. President Donald Trump finally revealed his long-awaited pick for the next chair of the Federal Reserve. The name was not the easy money loyalist that Wall Street had desperately priced in for months. It was Kevin Warsh, the former Fed governor known for his aggressive hawkishness and disdain for money printing. The high-frequency trading algorithms read the headline and immediately triggered a nuclear sell-off event. Silver, which had been touching a historic $121, collapsed instantly into free fall. In a matter of minutes, the price plummeted 37% to $76, wiping out months of gains. This was the single most violent repricing event in modern commodity history, shocking even the most veteran traders. I'm Daniel Brooks, and what you just witnessed wasn't just a healthy market correction. It was a total regime change in global liquidity expectations. The market realized in a split second that the Fed put is officially dead and buried. Kevin Warsh is not coming to print money to save stocks. He's coming to burn it. He has explicitly stated in recent interviews that the Federal Reserve needs a complete and total regime change. This specific phrase terrified the trading bots that control the leverage in the paper silver market. They dumped every long position they held, fearing a massive liquidity drain that would dry up the system. The result was a flash crash that left retail investors stunned, bleeding, and looking for answers. But if you understand the history of Kevin Warsh, this violent reaction was entirely predictable and inevitable. He's the man who famously warned Ben Bernanke about the dangers of inflation back in 2010. Before we dive into the terrifying mechanics of this crash and what comes next, I need you to subscribe to the channel right now and turn on notifications to stay ahead of the crowd. Leave a comment below with the city you're watching from today so we can track our reach. To truly understand why silver crashed so hard, you have to understand the specific Warsh doctrine. For months, the market believed Trump would pick a candidate who would slash interest rates to zero. Traders leveraged themselves to the hilt, betting on a future of infinite cheap money and currency debasement. Silver soared to record highs on this assumption of endless inflation and a compliant Federal Reserve chair. But Kevin Warsh represents a terrifying curveball for the leveraged paper speculators who were caught offside. While he supports tax cuts, he hates the Federal Reserve's bloated balance sheet with a passion. He believes the Fed has expanded its power far beyond its legal mandate and needs to be reined in. He wants to strip the Fed down to its bare bones and stop meddling in the financial markets. This means ending the purchase of mortgage-backed securities and treasury bonds immediately, effectively stopping the printer. When the Fed stops buying bonds, liquidity evaporates from the system instantly, leaving risk assets vulnerable to collapse. The algorithms know that silver creates no yield and relies on excess liquidity to sustain high valuations. So when Warsh was announced, the machines calculated a massive liquidity drought coming down the pipeline. They sold silver to buy United States dollars, spiking the currency index violently to new yearly highs. The dollar index ripped higher, acting like a wrecking ball to commodity prices across the board. This inverse correlation between the dollar and silver is the most powerful force in global financial markets. When the dollar spikes on hawkish news like this, silver is always the first casualty to fall. But the sheer violence of this particular move suggests something much deeper is broken in the market structure. A 37% drop in a few hours implies that there were absolutely no buyers stepping in. The order book simply evaporated, leaving a vacuum of air under the price that accelerated the decline. This is exactly what happens when a market is built on leverage rather than fundamental value. The longs were liquidated in a cascade that hunted for stops all the way down to $76. But here's the twist that the mainstream media is completely missing in their coverage today. Kevin Warsh is actually a believer in a stable, sound currency over the long term. He has criticized the Fed for allowing inflation to destroy the purchasing power of the middle class. His appointment is actually bullish for silver in the long term, not bearish as the price suggests. He wants to restore credibility to the dollar, which eventually exposes the massive national debt problem. If he stops the money printer, the interest on the national debt explodes to unsustainable levels. The United States government cannot afford real interest rates with $36 trillion in debt. So the market is crashing because it fears Warsh will actually do his job and fight inflation. He might be the Paul Volcker of our generation, willing to crash the market to save the dollar. Volcker raised rates to 20% in 1980 to kill inflation for good, causing a massive recession. That move crashed gold and silver temporarily before they found a true bottom and began a new cycle. We're seeing a historical echo of that 1980 pivot playing out right now in real time. The difference today is that the United States is bankrupt and cannot survive high interest rates for long. Kevin Warsh knows this, which makes his nomination a game of 4D chess by Donald Trump. Is he being brought in to crash the system on purpose to reset it for a new era? Or does Trump believe that Warsh can magically cut rates without causing a massive spike in inflation? The market voted yesterday with a resounding no to the soft landing narrative that everyone hoped for. They believe Warsh is going to break something in the plumbing of finance to restore order. And the first thing he broke was the paper silver market on the COMEX exchange in New York. But while the paper market burned, the physical market did something incredible and telling on Friday afternoon. Bullion dealers did not lower their prices to match the panicked futures market on the screen. They held their premiums high, creating a massive spread between the paper price and the physical metal. This Warsh spread is the new reality we have to navigate as investors in this volatile environment. It signifies that the physical market doesn't believe the price on the screen is legitimate anymore. They know that a hawkish Fed chair cannot print silver molecules out of thin air to meet demand. Warsh can destroy the paper price with a single speech, but he cannot create new silver supply. The mines are still depleting, and the solar panels still need the metal to function effectively. Samsung and Tesla don't care who the Federal Reserve Chairman is today or tomorrow. They only care if they can get the silver they need for their production lines to keep running. And right now, the crash has made physical silver harder to find, not easier, for these industrial giants. Sellers have gone into hiding, refusing to sell their hard assets at these artificially suppressed levels. This supply shock is going to collide with the paper crash very soon, creating a massive squeeze. When the dust settles, the Warsh crash will be seen as a classic bear trap for retail investors. It flushed out the weak hands who were betting on a pivot narrative that turned out to be false. It transferred the metal to strong hands who understand the structural deficit reality of the silver market. But the pain is real for anyone who was holding a leveraged call option during the drop. Those accounts were wiped to zero in the blink of an eye yesterday, leaving nothing behind. This is why we always warn against playing the casino games of the bankers with leverage. They own the casino, and they can change the dealer whenever they want to stack the deck. Trump changed the dealer to Kevin Warsh, and the House swept the table clean of all players. But the game is far from over. In fact, it's just beginning for the astute investor. Before we go deeper into what's happening behind the scenes, I need you to understand something critical. What you're witnessing is the divergence between paper manipulation and physical reality reaching a breaking point. If you want to stay ahead of this story as Monday unfolds, hit that subscribe button and turn on all notifications. We're tracking the physical market, the COMEX data, and the industrial positioning in real time. Drop a comment right now. Did the Warsh announcement catch you off guard? Or did you see this coming? I want to hear your take. Now, let's talk about the Japanese bank that actually broke the market. While the American banks were selling to satisfy the new sheriff in town, a much larger disaster was unfolding in Tokyo. We've uncovered evidence that a massive Japanese institution, the Norinchukin Bank, was the whale that broke the market. Norinchukin is often called the CLO whale because they hold a massive portfolio of collateralized loan obligations and U.S. Treasuries. They bet the farm that U.S. interest rates would fall, increasing the value of their massive bond holdings. But the nomination of Kevin Warsh signaled that rates are staying higher for longer, devastating their bond portfolio's value instantly. By mid-afternoon, rumors were swirling that Japanese regulators were demanding Norinchukin raise capital to cover a $20 billion hole. To stay afloat, they were forced to liquidate their crown jewels, creating a massive sell order that hit the silver market at the worst possible time. This was not a strategic decision based on the fundamental outlook for silver or any analysis of the metal's true value. It was a forced liquidation event driven by sheer desperation and the need to survive a regulatory capital call from Tokyo. The sharks on Wall Street, specifically the high-frequency trading desks in New York, saw this massive order flow hitting the tape. They immediately recognized the smell of blood in the water and knew a whale was puking its entire position into a thin market, so they shorted the market aggressively to front-run the liquidation, driving the price lower to profit from the Japanese bank's misery. They effectively kicked a man while he was down, using the Japanese bank's distress to trigger the retail margin calls that followed. This predatory trading is legal, but it creates a price signal that is completely divorced from the reality of supply and demand. But while the paper market was being destroyed by these banking games, the physical market was reacting in an explosive way. As the price crashed to $76, a massive wave of buying interest emerged from the most unexpected place: Costco. On Saturday morning, the wholesale giant listed 100,000 tubes of Silver Eagles on their website at the new crash prices. In a normal market, this amount of inventory would take days or even weeks to sell through completely to their members. But according to leaked internal data, the entire inventory of 100,000 tubes was sold out in less than 4 minutes. This was a frenzy of buying that crashed their payment processing servers and left millions of customers refreshing their screens in vain. It proves that the average American is waking up to the scam and is eager to exchange paper currency for real metal. Costco is now reportedly trying to source more metal, but the U.S. Mint has told them there's simply no product available. This creates a bottleneck where the demand is infinite, but the supply is zero. Yet the price on your screen continues to drop. It's a paradox that can only exist in a manipulated system. But it also creates a massive opportunity for arbitrage. While Americans were fighting over tubes of coins, the industrial giants of the world were quietly making their own strategic moves. We've received intelligence that Samsung has dispatched a team of procurement officers to Mexico City to negotiate directly with miners. Samsung's new solid-state battery technology, set to launch in the Galaxy series, utilizes a silver carbon composite anode for higher density. This single technological shift is projected to consume 16,000 metric tons of silver annually if adopted by the broader EV market. Samsung knows that they cannot rely on the COMEX to deliver this metal because the vaults in New York are effectively empty. If they rely on the paper market, they risk shutting down their production lines, costing them billions in lost revenue and market share. So they're bypassing the market entirely, offering miners a premium above spot price to secure exclusive rights to production. This is the beginning of the off-take war, where tech giants consume the supply before it ever reaches the public markets. When Apple, Tesla, and Samsung start fighting over silver mines, the price on the COMEX becomes completely irrelevant to reality. But perhaps the most damning evidence of the broken market is what's happening right now on the Shanghai Exchange. While New York traders were selling paper contracts in a panic, Chinese traders were buying physical metal with both hands. The price of silver in Shanghai is currently trading $26 higher than the price in New York. A massive arbitrage. This means you could theoretically buy a bar in New York for $76 and sell it in Shanghai for $102. This arbitrage window acts like a giant vacuum cleaner, sucking every available ounce of silver out of the West instantly. Smart money is taking delivery of COMEX contracts, loading the bars onto armored transport planes, and flying them directly to Shanghai. This is draining the COMEX vaults at a record pace, leaving the exchange with nothing but paper promises and empty vaults. The registered silver category, which represents metal available for immediate delivery, has dropped to levels not seen since the 1970s. If this drain continues for another month, the COMEX will face a force majeure event where they cannot fulfill delivery obligations. They'll be forced to settle contracts in cash, effectively admitting that they've run out of silver and defaulted on the market. This would be the end of the US dollar's dominance in commodity pricing and the beginning of a BRICS-led commodity era. China knows this, which is why they're not crashing the price. They're letting the West crash it for them. They're happy to buy our silver at a discount, knowing that it's the strategic metal of the future economy. The transfer of wealth is happening in plain sight, and U.S. regulators are either too incompetent or too corrupt to stop it. Listen, if this deep dive is showing you the mechanics of how paper markets are being drained by physical demand, I need you to share this video right now. Most investors have no idea what's happening in Shanghai or with Samsung's procurement teams. Share this with everyone who needs to understand that the price on the screen is fiction, and drop a comment. Are you holding physical silver or are you trading paper contracts? Because that distinction is about to matter more than ever. Now let's talk about the March delivery deadline. There's one final piece of the puzzle that explains why they're so desperate to keep prices down right now. It involves a deadline that's approaching in March, a deadline that the COMEX cannot avoid or delay any longer. The open interest for March delivery is currently 3 times larger than the amount of silver available in the vaults. If those contract holders demand delivery instead of rolling over, the exchange will default and the game will end. The March futures contract is the specific battlefield where this war between paper and physical will be decided. In the futures market, the active month is the contract that has the most volume and is approaching delivery. Right now, the March 2026 contract is the front month, meaning it's the price you see on your screen. Typically, traders will roll their positions out of March and into May to avoid taking delivery of the metal. But the data shows that open interest in the March contract is not dropping as fast as it usually does. This implies that there are entities, likely industrial users, who intend to stand for delivery next month. They don't want cash, they want the metal, and they're using the dip to grab contracts on the cheap. If these industrial users stand for delivery, the COMEX will have to find millions of ounces of silver in weeks. The registered stocks in the COMEX vaults are sitting at multi-year lows, leaving very little room for error. If the requests for delivery exceed the available metal, the exchange will be forced to declare a force majeure. This legal clause allows them to settle the contract in cash, effectively defaulting on their obligation to deliver metal. A default on the March contract would send shockwaves through the global financial system that would dwarf Friday's crash. It would prove that the price of silver has been suppressed by selling paper claims that have no backing. This is why the next few weeks leading up to the March delivery deadline are the most critical in history. The banks are desperate to shake you out before that deadline arrives so they can reclaim the contracts. They need your silver to cover their naked shorts before the industrial buyers come knocking on the vault door. That's why they engineered the crash on Friday. And that's why they'll likely hammer the price on Monday. It's a desperate game of musical chairs, and the music is about to stop for the paper shorts. The sun is about to rise on what promises to be the most chaotic Monday morning in the history of the commodities market. While the markets are technically closed for the weekend, the shadow banking system never sleeps. The panic is already spreading. Traders are currently staring at their screens in London, Singapore, and New York, waiting for the electronic markets to reopen in Asia. The Monday Open is going to be a moment of truth that will either confirm the crash or trigger a legendary reversal. We're already seeing indications from the gray market that the price of silver is going to gap down at the open. A gap down is when the price opens significantly lower than where it closed on Friday, skipping all the price levels in between. This is the ultimate nightmare for anyone holding a leveraged long position over the weekend, as there's no chance to exit. They'll be trapped in their positions, facing immediate margin calls that must be met with cash within the hour. This Margin Call Monday is designed to flush out the last remaining speculators who refuse to sell on Friday. The banks know that retail traders are praying for a bounce, so they'll likely push the price lower to break their spirit. But while the paper price might dip lower in the early hours of Monday, the physical market is signaling a massive squeeze. We've received reports that major bullion dealers have spent the weekend frantically calling mints to secure inventory. They're not calling to sell, they're calling to buy everything that isn't bolted down to the floor. They know that when the public wakes up on Monday and sees the price, the buying frenzy will empty their shelves in hours. This disconnect between the paper open and the physical open is where the real profit opportunity lies. The paper price is reacting to the Kevin Warsh nomination and the fear of a liquidity withdrawal. But the physical price is reacting to the reality that you cannot print silver and the world is running out of it. You must ignore the noise of the daily price fluctuations and focus on the signal of physical scarcity. The signal is flashing red, telling us that the vaults are empty and the miners are tapped out. The paper price is a distraction, a magic trick designed to make you look at the wrong hand. Look at the other hand, the one that's quietly moving the physical bars from London to Shanghai. That's where the truth lies, and that's where the future price of silver will be discovered. The Monday Open will be scary, volatile, and likely manipulated by the algorithms to induce maximum fear. But if you can keep your head while everyone else is losing theirs, you'll spot the entry of a lifetime. The smart money waits for the panic to subside and then steps in to buy the blood. They know that the cure for low prices is low prices because it kills supply and stimulates demand. At $76, silver is now trading below the all-in sustaining cost of many marginal mines. This means mines will shut down, supply will drop further, and the shortage will intensify. Economics 101 dictates that when supply falls and demand remains constant, price must rise. It's not a matter of if, but when, and the when is likely closer than the bears think. The V-shaped recovery from this crash could happen as early as mid-February. Once the margin call selling is exhausted, there will be no one left to sell at these levels. The market will run out of sellers, and the buyers will have to bid the price up to find liquidity. This liquidity vacuum works both ways. It caused the crash, and it will cause the melt-up. We saw this exact dynamic in March 2020 when silver crashed to $12 and then rocketed to $30. The people who bought at $12 made fortunes. The people who sold lost everything. History is offering you a second chance to be on the right side of the trade. Do not let the scary headlines about Kevin Warsh or the Fed distract you from the math. The math says that we're consuming more silver than we're producing, and the deficit is growing. The math says that debt is compounding faster than GDP, and the currency is mathematically doomed. The math says that silver is the most undervalued asset on the planet relative to the money supply. The crash was a gift, a chance to lower your cost basis and increase your ounce count. But you have to act before the window closes because the physical market is tightening by the hour. I'll be monitoring the Monday Open Live, tracking the order flow and the inventory levels. I'll be watching the March contract specifically to see if the open interest starts to drop or hold steady. If the open interest holds, we know the squeeze is on and the banks are in trouble. If the open interest drops, we know the speculators are washing out and the bottom is near. Either way, we'll have the data we need to make informed decisions, not emotional ones. The emotional trader sells the bottom. The informed investor buys the fear. There's a lot of fear in the market right now, which means there's a lot of opportunity. Do not let them shake you out of your position just days before the reversal begins. Hold your ground, trust your research, and remember why you bought silver in the first place. You bought it because the system is broken. And Friday's crash just proved how broken it really is. Subscribe to this channel. Turn on notifications. We'll be here tracking every tick, every trade, and every ounce when the bell rings on Monday. Stay safe, stay stacked, and I'll see you on the battlefield. I'm Daniel Brooks, and this is just the beginning. They dumped every long position they held, fearing a massive liquidity drain that would dry up the system. The result was a flash crash that left retail investors stunned, bleeding, and looking for answers. But if you understand the history of Kevin Warsh, this violent reaction was entirely predictable and inevitable. He's the man who famously warned Ben Bernanke about the dangers of inflation back in 2010. Before we dive into the terrifying mechanics of this crash and what comes next, I need you to subscribe to the channel right now and turn on notifications to stay ahead of the crowd. Leave a comment below with the city you're watching from today so we can track our reach. To truly understand why silver crashed so hard, you have to understand the specific Warsh doctrine. For months, the market believed Trump would pick a candidate who would slash interest rates to zero. Traders leveraged themselves to the hilt, betting on a future of infinite cheap money and currency debasement. Silver soared to record highs on this assumption of endless inflation and a compliant Federal Reserve chair. But Kevin Warsh represents a terrifying curveball for the leveraged paper speculators who were caught offside.